Okay, so moving on to 12.5, real estate loans. Determining the monthly payment on a home. A home is one of the most expensive purchases that a person makes in his or her life. The monthly payment for a home mortgage depends on the amount borrowed, the interest rate, and the term of the loan. You can see how mortgage interest rates have done over the last, let's see, it looks like maybe 40, 50 years or 40 years. And from a historical perspective, our interest rates are relatively low. This was in 2017. I think they're actually a little bit lower than this now. I think we're closer to 4, maybe 3%, 3 and 4% for a typical loan, and that might be going down. Just like most of the things that we've looked at before, there's going to be another table that we can use as a lookup. Most home loans are in a 10, 15, 20, 25, or 30-year term. So we have those broken down, and then we have the interest rates of what you normally would see from 4% all the way to 8.5%. Okay, so I'm sure we're going to reference this real estate table. Okay, after making a down payment, the stringers need to borrow $140,000 to purchase a condominium. They want to know the effect of the interest rate and the term of the loan on cost. Find the monthly payment for both 15 and 30-year 4%, 6% loans, and then find the total cost of the home with each loan and the finance charge of each loan. So 15, 30, and 4% and 6%. So this is just the table lookup. We know that we've borrowed $140,000, so we're going to use the 140, and then we're going to multiply it by the factors that are appropriate. So let's go ahead and use the 4% in 15 years. 4% in 15 years. Let's go look that up, that factor. We're just going to look up the first one, and we know that the rest of them are going to be okay. So 4% 15 years. 4% 15 years, 7.4. That's the factor, okay? So what we're going to do is we're going to figure out, well, how many thousands do we have in what we're borrowing? We have 140,000, and so we have 140 of those thousands, right? Or in other words, you can take the 140,000 and divide it by 1,000. You're going to get 140. Okay, so we'll take the 140, we'll multiply it by the factor that we found, 7.4, and our monthly payment is going to be $1,036. Under 6% for 15 years, we look on that table again, we'll come up with the 8.44. We'll multiply the 8.44 times the 140, and that gives us $1,181.60. Pretty straightforward. And then 4% for 30 years, the factor is going to be 4.77. At 140 times 4.77, that's going to be 667.80. And then a 6% at 30 years for 6% interest for 30 years is the factor is going to be 6.0. And we'll take the 6.0 and multiply that by 140. So we have our monthly payments based upon the different interest rates and different terms. So now we're going to compare the two. If we take the 1,036 and it's for 15 years, so we'll multiply that by 15, but then it's monthly payments, so we'll multiply that by 12. The total amount of payments or total payments will be $186,480. Keep in mind we borrowed $140,000 and we're going to pay back $186,480. That's under the 4% for 15 years. Under the 6% for 15 years, we're going to end up paying $212,688. So you can see already that there's a pretty large difference, even with a 2% difference between the two loans. And then if we push it out for 30 years on 4%, now we're looking at $240,408. It's going to be paid over the lifetime of that loan. And then for 6% for 30 years, $302,000. So if you think about it, 4% at 15 years, you're going to end up paying nearly half the amount that you would pay for 6% over 30 years, nearly half. And that's the effect of interest rates over a long period of time. It does get expensive. The final part here is let's compare which ones. Are we going to compare the 15 and the 4 and 6%? So from the term of the loan, the finance charge or interest costs of each loan is the total cost in part B minus the 140,000. So for 15 years at 4%, we're going to take the 186,480 and we're going to subtract 140,000, and that's going to leave us 46,480. So that's what you're going to end up paying in interest, all right? We go to the last one, 6%, at 30 years, if we take the 302,400 and we subtract from that 140,000, we're going to end up paying 162,400 in just pure interest. All right, so you can see the difference. That's going to be about a little less than $120,000 that we're paying extra for two reasons: higher rate and longer term. Okay, so we can prepare a repayment schedule. This is like an amortization schedule that is very similar to what we've learned already before. Let's take a look at how this works. After making a large down payment, Zinks purchased a new home borrowing $195,000 at 7% and 30 years. Prepare a loan amortization for this loan. So they borrowed $195,000. We're going to go ahead and try to figure out what the payment is. The way the payment we figure out, we're going to take $195 and we're going to multiply it by the payment factor based upon 7% and 30%. So let's go look it up. You can go look it up if you'd like. I'm going to go ahead and trust the book did the right thing, and we're going to go run down here. So it's $195 multiplied by the factor at 7% and 30 years, 6.65%. That's from the table itself. So that when we do that multiplication, we're going to come up with a monthly payment of $1,296.75. That's our monthly payment. Now from here, we can actually create a amortization schedule. I don't think we're going to do this for the entire loan. I don't think so. We just do that for maybe 1 or 2 months. Oh, it says loan payment schedule for this loan. Okay, so we'll do that. Our first payment, just like we did in the auto loan, we're going to use PRT. So the outstanding amount is $195,000. We're going to multiply that by 7%, and then we're going to multiply that by 1/12 because it's 1 out of 12 months. So the amount of interest that's going to be charged on the first payment is $1,137.50. Now remember, our payment is $1,296.75. So very little of that $1,296.75 at first is going to go against the principal. Most of it is going to be paying interest. But let's go ahead and figure that out. So $1,296.75, we're going to subtract $1,137.50. That's interest. What's going to be applied to the actual principal will be $159.25, $159.25. So we're going to take the balance at the beginning of the period of $195,000. We're going to subtract $159.25, and after we make that first payment, we only owe $194,480.75. So just noting that a good portion of that payment went towards interest. All right. But the good news is that every time we lower that principal amount, the interest decreases every period. It's going to be slow at first. It'll be relatively small adjustments at first, but over time, you know, that eventually you're going to start paying that payment down significantly. So in the second month, the interest PRT, we're going to take the outstanding balance after the first month's payment. We'll take that outstanding balance, and then we're going to multiply it by 7% again, and we're going to multiply it by 1/12. So that's 1 of 12 months. It's for 1 month. The interest portion will be $1,136.57. Now we compare that to the $1,137.50. You say, okay, well that's lower. It's not that much lower, but it is a little bit lower. And again, like I mentioned, your first few payments are not going to change significantly. It's going to feel like you're just kind of going nowhere on this loan because most of your payments are going towards the interest. But a portion is going towards the principal. So how much? Well, we take the $1,296.75, that's the monthly payment. We're going to subtract from that the $1,136.57, that is the interest portion. That's gone, that disappears. And what gets applied to the principal is $160.18. Almost $1 more is being applied to the principal. So we're going to take the $160.18, we're going to apply that to the balance of the principal. $194,840.75 minus $160,118 gives us a new balance at the end of the second payment of $194,680.57. Okay. Now we can do this forever, but we're not going to do it forever. Here's like how the payment schedule or the amortization schedule would look. You have zero, you have 195,000 borrowed, okay? And then we're gonna look at the first payment. $1,137.50 are going towards interest. $159.25 is going towards principal. We take the 195, we subtract the 159.25, and that's the 194,840. That's exactly what we computed just up here, 194,840. So this is just a table that shows, or a schedule that shows exactly how the payment is occurring every time we make a payment. We can do this way before. We can, plot this out all the way through to the end of the loan, 360 payments for 30 years. We'll do the second payment. The second payment had $1,136.57 applied to interest, $160.18 towards the principal, and so we have $194,680.57. That's the remaining balance. Okay. That's what we had up here, so we're applying. Then from then on, it's just doing the same thing over and over again. PRT, I equals PRT, figuring out what the interest is, and the difference between the total payment and the interest becomes the principal portion. And we take that principal portion and we apply it to the remaining balance, and we reduce the remaining balance. And you can see as payments are being made, the principal portion increases and the interest decreases. Principal portion increases and the interest decreases. Towards the end, when we're getting to the very last payments, let's say on payment 262, for whatever reason, where they're showing that, the total payment is still the $1,296.75, but of that $1,296.75, 570 is going towards, 570.02 is going towards the interest, which means 726.73 is going towards the principal. And now the principal is getting reduced much more significantly than it did at the very beginning. And then even on the last payment, we only paid $19.14 of interest. The principal is $1,277.61. So it flips. It's like when you get towards the end of the loan, the majority of your payment is going to be going towards the principal, and the interest is going to be much less than it was when you started. Moving on to page 493. Okay, now what you're seeing is just the payment as it relates specifically to the loan, the borrowed amount, the interest, and the principal portion. What you learn when you're buying your first house is that's not all that you're going to pay. The mortgage company is going to want to make sure two things are paid annually. They're going to want to make sure that the taxes on the home are paid, the property taxes, and they're going to want to make sure the insurance is paid on the home. The reason why they want the property taxes is because the county can come in and foreclose on the home if the county taxes are not paid. So it's in the best interest of the mortgage company to make sure that those taxes are paid, so that way they don't end up losing the house or a claim on the house when the owners don't pay the taxes. So it's in the best interest of the mortgage company to go ahead and include the tax portion on the payment. In addition to that, God forbid if the house were to catch on fire, the house burns down, there's nothing there to continue to pay. So the owner of the home is going to be less motivated to pay for something that doesn't even exist. Just the land exists, not the structure, not the building. So the owner's going to say, why would I pay this loan, right? There's no use for it because I'm going to pay back for nothing. Well, if you have a good insurance policy, there's a good chance that house can be rebuilt. Well, so the mortgage company is thinking, let's make sure that the insurance is on the home. And so to do that, they're going to require that the insurance gets paid as well on your payment. So in addition to that payment that you're making that is just purely principal and interest, you're going to have to make an additional amount of payments that are going to be applied to the taxes and the insurance. The question is how do they configure that out? So let's go ahead and go through this process of figuring this out. The Campbell family borrowed $322,450 for 25 years at 5% interest. So we can go to that table and figure out exactly what the loan payment is going to be. All right, what it is, it's not really that relevant. Their annual insurance and taxes on the property, this is both, insurance is $940 and property taxes is $7,382. So the mortgage company is going to want to include that amount in the payment. Now, how do they do that? Well, what they're going to do is they're going to take these two amounts, 7382 and 940. They're going to take those two amounts and they're going to add them together. 940 plus 7. So that's the annual amount between the two of them, what you have to pay. So I guess we can come up with a spreadsheet to figure exactly how much that's going to be. Looks like it's going to be something like 82 something. Say 940. And 7382. So we add these two together and we come up with 8322. So $8,322. So that's what these added up together, and then we're going to divide that by 12. Why? Because it's going to be easier to pay those on a monthly basis, right? So in essence, that amount, 8322, is going to be broken up by month, so that every month you're going to have to pay an additional amount, and including the principal and interest, you're going to have to pay $693.50. And that goes into what's called the escrow accounts. It goes into it like a bank account, and they're going to accumulate those funds over time, and whenever a bill comes due, either the property tax bill or the insurance bill, they'll take the money out of that escrow account. Okay, so the payment itself, though, they borrowed $322,450. So we're going to divide that by 1,000. We're going to come up with 322.45, and we're going to multiply it by the factor of 5.85. Where does that come from? That comes from the real estate amortization table at 25 years and 5%. So the factor is 5.85. All right, so we run those numbers, 322.45. This is coming up with our payment, 322.45. And then we have 5.85. So just the loan itself is going to cost, $1,886.33 per month. That's the monthly payment. And then we're going to add to that the monthly payment of $693.5. 693.5. And when we add that two together, 1886.33 plus the 693.50 will come up. So their monthly payment, including taxes and insurance, will be $2,579.83, $2,579.83. Even though their monthly payment is, for just the loan is $1,886.33, they're still going to pay $2,579.83 so that they can cover the insurance of $693.50 and taxes of $73.82. $2,579.83, $2,579.83. Okay. Now, when you go buy that first home, you're going to learn that there are different ways to borrow money. You can do what's called a fixed rate, which means the rate does not change. Whatever that rate is, it remains fixed throughout the entire term of the loan. Or you could go with what's called a variable rate. Variable rate loans, sometimes those loans are actually a little lower, but they're subject to change. Most people actually feel better just borrowing a fixed rate so that they know exactly what it's going to cost them for 30 years. Some people like to roll the dice a little bit and go with a lower rate, thinking that, well, we'll go with the lower rate and hopefully it won't go up, but if it does, there will be caps on it, but chances are those caps are going to be higher than the fixed rate. So you're rolling the dice a little bit. The next thing we're going to go through is discussion of a credit score. Whenever you're going to be looking to buy a home, or even when you buy a house or a house or car, something that's relatively expensive that's going to be made payments over an extended period of time. You're going to end up, these companies are going to run what's called a Fico score. Okay, the Fico score is essentially a credit score, and generally speaking, they range between 300 and 850. 300 and 850. Generally speaking, they can be higher, but it just kind of, and I think they can be lower as well. It just kind of depends on the circumstance. And then it also depends on what credit agency they're going to be using as well. You know, they all have pretty similar scores, but certain companies have higher scores than others, okay, for whatever reason. Generally speaking, though, if we're just talking about the rule of thumb, if your credit score is 730 or better, then you'll be considered to be an excellent creditworthiness, and so you're going to be offered the best interest rates. On the other side of the table, if you're below 585, then you're going to be considered a very high risk. Many times you'll be denied credit. In some cases, if they do give you the credit, they're going to make you pay a very high interest. And the reason being is that with every high interest, with every high risk, they want to be rewarded for that, so they're going to be asking for a higher interest rate. Now, the textbook goes on to talk about how you can keep a good credit score. All right, your FICO score is going to be based on the weighted average of the following: your payment history, the amount you owe, the length of credit history, new credit, and types of credit in use. Payment history, from my experience, from what I know and what I understand, your payment history is actually going to be the biggest factor. Meaning if you miss a payment that's due, if you actually skip a payment or miss a payment, your credit scores are going to be impacted significantly. The amount owed, how much you actually owe on your outstanding balance. If you owe way too much or not enough, those are both going to have negative impacts. You want to owe a good amount to show that you have credit history and responsibility, but you don't want to owe too much to make it appear as if you're sinking or underwater. Length of credit history, so if you're relatively young, you're not going to have a very good credit score because you don't have the scores or the history to show it. New credit, particularly when they're running the credit scores, if they start to see that you've been having a lot of new credit that's been issued to you in a recent period of time, then that may impact your scores negative, especially if you have credit reports running and agencies checking your credit regularly. And then types of credit in use. Home mortgages are usually going to be favorable because they're longer periods of time. Credit cards are not going to be, especially if you've got a lot of credit cards with a lot of outstanding balance, that's not going to be looked upon favorably because those are a bit of a higher risk. And they're unsecured, so there's nothing that they can remove or take away from you if you don't pay your bill. Some lessons that the textbook offers is pay bills on time, and I'm going to reiterate this. This is the biggest impact. All these other things and everything you've heard in your discussions with people and friends and family that try to give you advice, all of it is true. Don't get me wrong when they talk about how much you have outstanding and everything. It's all true. But the biggest negative impact that's going to hit your credit scores is if you don't pay your bills on time. If you miss a payment, it's going to really have a really bad impact on your credit score. So make sure you pay your bills on time, catch up on any back payments, pay down the amounts owed so that you are not using more than 30% of the credit limit on any account, maintain credit cards for long periods of time, and do not open new accounts too frequently. Those are all really good recommendations. But if you want to know which one's going to impact the biggest, it would be the top one. You can do all these other ones have an impact. There's no question about it. But the pay bills on time is going to have the biggest impact on your scores. Okay, that concludes 12.5, and that also concludes Chapter 12.